Hey, everybody, we are going to talk about some interesting companies that we think have a lot of qualities that make Warren Buffett's businesses so successful together. Um, of course, you can't buy some of the subsidiary companies that Buffett owns all by themselves, so we're going to try to offer a few alternatives. Tyler's joining me today. Before we get started, please take a minute and check out fool.com/Frankel, the link you see on your screen. Get the top 10 stock ideas from the Motley Fool right now, and it's the best way to support this work we're doing. Again, fool.com/Frankel. So, Berkshire owns a lot of companies in the insurance industry, in the construction industry, in the home building industry, energy, et cetera, et cetera. And of course, we can't buy them. There's no way for you to directly invest in Geico, for example, or Clayton Homes, or BNSF Railroad. But there are public companies that can be nice substitutes for these, some of which have a lot of Berkshire-like qualities. So I have one in the insurance industry, which is Berkshire's core business. But before I do that, Tyler, what are you looking at? Because I'm actually really interested in this company.
Sure. So I'm, like you were saying, there's a lot of kind of building, construction materials kind of businesses in the Berkshire portfolio. One that really comes to mind is like John Mansville, Acme Brick Company, things like that. Building products. It's a cyclical business, but one of the reasons that Buffett tends to like businesses like this because he's a patient investor, and people who are patient and have a good eye for valuation can do well in these sort of businesses because they tend to be pretty, despite being cyclical, they still grow pretty, more or less with population growth and economic development because it's kind of hard to disrupt housing and buildings. It's one of those kind of, it's probably going to be here for another 50 to 100 years. So the company that I wanted to focus on here is, I would call it kind of a substitute for like Johns Mansville or something like that, and it's James Hardie. James Hardie Industries is a company who specializes in the manufacture of what they call fiber cement paneling. So that sounds fancy. It's a product called Hardie Plank, but basically what it is instead of having like a wood clapboard or like a cedar shingle or something like that you would use for the side of your house, they actually manufacture a board that has like some wood grain kind of designed into it, or whatever design you want to build into it, with a combination of wood fibers like sawdust with a cement product. And this comes together in a solid product that you can apply to the house. It started hitting the United States. It was very popular in Australia, but it hit the United States about 20, 25 years ago. I remember I was actually working on a siding and roofing crew when we started using James Hardie. And at the time, I kind of hated it, but it's a much, much better product now than it was 20 years ago. It's considerably cheaper than, traditional wood siding, but it has a much, much nicer quality look than, say, like vinyl siding, which has kind of been the real target market for James Hardie in the United States, is kind of taking on that vinyl siding wooden or sort of market where people want an upgraded look on their house for refurbishment as well as for new building. So since 2010, vinyl siding in the United States has lost about 10-12% of its market share, while James Hardie or fiber cement products have taken about 9%. So you have this combination of new build construction, rehab, rehabilitation kind of growth. And on top of that, this particular product has been taking market share because it is a slightly nicer product. And from a construction side, it's, I would say, easier to work with than vinyl in my personal experiences with it. So again, it's a cyclical business right now. It's been quite slow. Rehab and rehabilitation in the United States market has been next to nothing for the past couple of years because of higher interest rates. Most of what they have been selling lately has been to large developers for single family home construction, which is, as we have said on multiple videos before, single family new builds has been like the kind of the largest source of home or 30% of home sales when it's typically like 5 to 10%. So there's a lot of opportunity there. And my thesis is with a little bit of rate cut, you're going to see probably an uptick in rehab and rehabilitation for a lot of homes, which will be a kind of a growth lever for this company. But despite that, despite the slow market now, it's still actually growing. It's still quite profitable. It's like 32 times earnings, but again, that's kind of from a slower earnings base that we've had in the past couple of years. But on a profitability basis right now, we're still talking about a company that's generating about 27% returns on equity for a relatively slow growth industry, or what should technically be the bottom of the cycle. So you have I would say, a very quality business generating good returns for you as an investor, with some good upside potential that is very much in the mold of a Buffett Berkshire kind of product. Like I said, earnings looks a little like price to earnings looks a little high. But I think with the potential growth we're going to see in the next couple of years with rate cuts and increased activity, I think that might be actually a good price worth paying. And before I forget again, the ticker, JHX. I forget them all the time.
Awesome. So I wanted to actually, before I move on to mine, mention a couple things about James Hardie. My house has Hardie plank siding. I live in a D.R. Horton house, and that was used to build my home. Fantastic product. We've been in our house for just over 10 years now, and it looks just like it did when we bought the house.
You haven't had to paint it, have you?
We have not had to paint it. We've pressure
10
washed
years,
it
no
three
paint.
times. Yep, we pressure washed it 3 times, and it looks exactly the same. But you brought up a really good point about the interest rate tailwinds. So I wanted to just bring one statistic here. Americans are currently sitting on $32.8 trillion in home equity that they're really not tapping into pretty much at all right now. No one wants to take out a home equity loan when your interest rate is going to be 7%. No one wants to get a home equity line of credit when you have a variable rate that's about 10%, which is the average right now.
Knowing full well that in 18 months or so, it's going to be quite lower.
Right. So there's all this pent up, and historically, that's where a very big portion of the renovation market comes from, is people tapping into their home equity. Not only is it a cheaper form of debt, but you actually get a tax write-off for it if you use it for if you borrow money, if you take out a home equity loan or a cash out refinance, and then use the proceeds for real estate purposes, with rehabbing your home counts. It's a really attractive way to redo your house, and it's not attractive at the moment, but it's going to get there. So I really like this pick. It's one that I'm going to dig into a little bit more. I think it could have a massive tailwind from lower interest rates, especially because siding is a big project. You mentioned it's a great product, but redoing siding on a 4 or 5 bedroom house is not cheap. So people need a way to get the funding, an economical way to get the funding. So I was going to go in the insurance side. Berkshire loves insurance. It's a company I've talked about a few times. It's called Kinsale Capital. We recently did another video of Berkshire comparisons where I talked about Progressive, and I like this for a different reason. One, it is a very profitable insurance company, but really it's the investment strategy that makes this stand out to me right now as kind of a future Berkshire almost. If you're not familiar, Kinsale is a specialty insurer. You wouldn't go to them for your car insurance or homeowners insurance or things like that. But if you were going to open a business that had a very high risk of people getting hurt, let's say you wanted to start a demolitions company, or Tyler mentioned a roofing crew, or something to that effect, that would be a business that you might want to go to Kinsale for, because traditional liability insurers might not want anything to do with you. If you were going to open a marijuana dispensary, or a business that is just really tough to gauge any risks, that would be something you would go to Kinsale for. So Kinsale is a specialty insurer, which is called the excess and surplus lines in insurance language. They're focused on smaller accounts, and they are the only pure play specialty insurer on the market. Now, they compete with a lot of big companies, including Berkshire, who has a specialty insurance business. Markel is one of the biggest in the industries. Lloyd's, I think, is the biggest. AIG is a big specialty insurer. So there are some big competitors, but Kinsale specializes in smaller accounts that are generally ignored by them. This makes them highly profitable. Specialty insurance is very hard, but it's highly profitable if you're good at it, and they certainly are. Excuse me. So I want to quickly share one graphic real quick. Um, so this is Kinsale compared to its peers. So what we're looking at, and I'm just going to quickly just mention the two important numbers. This is Kinsale right here, this bar that I'm hovering over right here. Kinsale's loss ratio is averaged 55.1% over the past 3 years. Now that's on par or even higher than some of its peers. You see a 46% in here. It's not that far off from its peers. The big difference is this number right here, the 22.1%. That represents its expense ratio, how much it costs to do its business. And you can see that is by far the lowest expense ratio among its peer group. And that has to do with its efficiency and its proprietary technology that it uses to underwrite. When you combine those two numbers, you get what's called the combined ratio. Kinsale's combined ratio over the past 3 years has been just over 77%. Subtract that from 100%, and you see Kinsale has about a 23% or underwriting profit margin before you consider any investments. It is a highly profitable insurance business. You can see the average peer had a combined ratio of about 93%, so about a 7% operating margin in the specialty insurance space. Kinsale's was about 3 times that. So, very, very profitable business. And like most insurance businesses, they invest the money that they take in that hasn't yet been paid out for claims. It's called a float. And like most insurers, most of it is in fixed income. Kinsale has quietly been shifting more and more of that into equities from fixed income over recent quarters. And recently, the company's CFO and kind of right hand man of the CEO, Brian Haney, said that the company is getting more comfortable now that it's getting bigger and it's consistently profitable. They're getting a little more comfortable with getting a little more creative with their investment strategy. So nothing, it's about like 10% in equities right now, 90% fixed income. So nothing too crazy right now. But over time, more and more of that is likely to shift. They're notably shifting more of the equities from ETFs and mutual funds to individual stocks. You can actually look up the quarterly SEC filing and see what stocks Kinsale owns. So the stock portfolio is getting bigger over time, and this is one that I think could be really interesting. It's got a lot of early Berkshire qualities. A lot of people, when you ask what's the next Berkshire Hathaway, Tyler, what's the company everybody says is the next Berkshire Hathaway? It's one that
I was going to say, Markel,
yeah,
but
everyone says Markel. And for obvious reasons. They have a pretty big stock portfolio right now. They have a venture division. They invest in businesses. Kinsale is like, rewind the clock a little bit. Kinsale's in the much earlier stages of shifting to that. So it's one to watch. They're a very profitable insurer, regardless of their investment portfolio. But their investment portfolio makes this a really interesting play over the long term to me. I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investment. So I'm proud to partner with The Motley Fool to bring you 10 stock picks from the popular product Stock Advisor. Stock Advisor has beaten the market by nearly 5 times. So go to fool.com/Frankel to get your 10 stock picks now. The Motley Fool Stock Advisor returns are 767% as of July 5th, 2024, and are measured against the S&P 500 returns of 163% as of July 5th, 2024.